In this next video, we are going to assess Ashley's Attic and Kadens Closet ability to pay all liabilities in 2026. And we will compare the two businesses on the following ratios: their debt ratio, their times interest earned ratio, and their cash flow coverage. Once we've computed these ratios, we will think about the following questions. Which company gets more of its asset funding from equity? How do we know? And based solely on these ratios, which company would we prefer to lend money to and why? So we're going to compute these for 2026. So now let's transition to the spreadsheet. So on the spreadsheet here, we're going to calculate the debt ratio, the times interest earned ratio, and the cash flow coverage. So let's do a little formatting here. I'm not going to color these. So I filled in the previous ones, so we know that those were one set of calculations. So the debt ratio is going to be total liabilities divided by total assets. So for Ashley's Attic, we can come to our financial statements here and sum up our total liabilities. So it's going to be these three items: accounts payable, other current liabilities, and long-term debt. And we can divide that by total assets. So that gives us a debt ratio of 0.28. And we can repeat the same for Kadens Closet. So Kadens Closet is approximately 0.37. Great. Now we'll calculate times interest earned. This is going to be income from operations divided by interest expense. So let's calculate this for Ashley's Attic for 2026. So let's take income from operations, that's right here, and divide it by interest expense right below it. Okay, so this is 17.66 for Ashley's Attic. We will repeat this calculation for Kadens Closet. We will take income from operations and divide it by interest expense. So we see that their times interest earned ratio is 11.06. Next, we'll look at the cash flow coverage. Cash flow coverage is the cash flows from operations divided by interest expense. So let's find cash flows from operations for Ashley's Attic in 2026. So there it is in D27, and divide it by interest expense. So it looks like this is 18.03. Similarly, we will do this calculation for Kadens Closet. We will take cash flows from operations divided by interest expense. This is 9.48. So this was our next set of analyses here. So I will fill these out with an orange box just to indicate that this was our next set of ratios. And returning to the slides here, right? These are the ratios for 2026. So we should discuss which company gets more of its asset funding from equity. How do we know? And which company would we rather lend money to and why? So for the first question, which company gets more of its asset funding from equity? That would be Ashley's Attic. And how do we know this? Because they have a lower debt ratio. So as a percentage of their total assets, liabilities are a smaller percentage than they are for Kadens Closet. So for the second question, this is an opinion question. So based on these ratios, which company would you rather lend money to? Why? So I would encourage you to think about this and maybe write this down on your paper as you're following along.